Hello students. Today I am going to solve one simple problem on accounting rate of return method. Before going to that, in the previous sessions we have discussed about methods of capital budgeting. There are two methods of capital budgeting are there. One is traditional method and another one is discounted cash flow method. Under traditional method, again it is subdivided into two types: payback period method and accounting rate of return method. First one, payback period method, we have completed. Now we are going to discuss about accounting rate of return method. First, let us discuss what is the meaning of accounting rate of return method. This ARR we can call accounting rate of return method as ARR. This ARR considers the earning capacity of a project and it is based on conventional accounting concept. What do you mean by this accounting conventional accounting concept? Here, conventional accounting concept means customs or usages followed by accountant. It is a guide in the preparation of financial statements. That is called as conventional accounting concept. Okay, what is the custom or the usage or the practices followed by the accountant? So there are some rules and regulations will be there at the time of preparing financial statement. Like that, here also for the purpose of calculating ARR, there are some rules, regulations, practices, customs will be there. And this ARR always it is expressed in the form of percentage. And one more thing here you have to remember is the higher the return on investment of a project, the better is the project. And one more important thing you should remember here, net profit. What type of net profit we should take for calculating ARR is net income after tax and depreciation. Net profit after tax and depreciation. Then in the PBP, what type of profit we were taking? Net profit. Net profit before depreciation and after tax. It is for the PBP. So there is a difference between the PBP and ARR. Here for the PBP net profit we were taking before depreciation and after tax. But for calculating ARR we will take net profit after tax and depreciation. First, there are some important formula we have to remember while doing the ARR. Without these formulae, you can't solve the problem on ARR. First, we will discuss what are the formulae. First one is ARR. What is the formula for ARR? Average annual income after tax and depreciation divided by average investment into 100. Or one more formula is there for calculating the ARR: average earnings divided by average investment into 100. Next, How to calculate this average earnings? The formula for that average earnings is total net profit after tax and depreciation divided by number of years. Next, how to calculate this average investment? See, for ARR, the formula is average earnings divided by average investment into 100. How to calculate this average investment? Initial investment minus scrap divided by 2. If working capital is given in the problem. ಪ್ರಾಬ್ಲಮ್ ಅಲ್ಲಿ ವರ್ಕಿಂಗ್ ಕ್ಯಾಪಿಟಲ್ ಕೊಟ್ಟಿದ್ರೆ ಅವಾಗ ಅವರೇಜ್ ಇನ್ವೆಸ್ಟ್ಮೆಂಟ್ಗೆ ಏನ್ ಫಾರ್ಮುಲಾ ಅಂತ ಹೇಳಿದ್ರೆ ಇನಿಷಿಯಲ್ ಇನ್ವೆಸ್ಟ್ಮೆಂಟ್ ಮೈನಸ್ ಸ್ಕ್ರಾಪ್ ಡಿವೈಡೆಡ್ ಬೈ 2 ಪ್ಲಸ್ ವರ್ಕಿಂಗ್ ಕ್ಯಾಪಿಟಲ್ ಪ್ಲಸ್ ಸ್ಕ್ರಾಪ್. Now look at the problem first. It is a very simple problem. A project requires an investment of rupees 10 lakh. So it is an initial investment. The plant and machinery required for the project will have a scrap value of rupees 80,000. Initial investment 10 lakh and the scrap value is given 80,000. This 80,000 is at the end of the 5th year. Okay. The profit after tax and depreciation is as follows. Here, what is the profit we required for calculating the ARR? The profit after tax and depreciation. Directly, the information, that is the net profit, is given here. And years is given, 5 years information is given, then net profit is given for 5 years. We need to calculate ARR. Okay. We will solve the problem now. Calculation of ARR. First, what is the formula for calculating the ARR? The formula what I am taking is here ARR is equal to average earnings divided by average investment into 100. The formula for calculating ARR is average earnings divided by average investment into 100. Okay. But average earnings, directly the information is not given in the problem. First we should calculate the average earnings. So here average earnings, the formula is total net profit after tax and depreciation divided by number of years. First, we will calculate the total net profit after tax and depreciation. Here the net profit is given. Net profit is given after tax and depreciation only. Okay. So first we have to take all the net profit. That is 50,000 for first year, second year 75,000, third year 1,25,000, fourth year 1,30,000 and fifth year 80,000. Okay. Now total net profit after tax and depreciation, I have taken 50,000 plus 75,000 plus 1,25,000 plus 1,30,000 plus 80,000. So the total net profit after tax and depreciation is rupees 4,60,000. Next, here after calculating this, we need to calculate the average earnings. How to calculate the average earnings? Total net profit after tax and depreciation divided by number of years. Here, total net profit after tax and depreciation is rupees 4,60,000. That I have entered here. divided by number of years. For how many years the information is given? For 5 years. So 5 years. 4,60,000 divided by 5. Average earnings is rupees 92,000. After calculating average earnings, the next one is, see, we need average investment. Now we are going to calculate the average investment. The formula for calculating average investment is initial investment minus scrap divided by 2. Here, initial investment, it is given in the problem 10 lakhs minus scrap. The scrap value is also given 80,000 divided by 2. Okay. Average investment is 4,60,000. Next. Now we have calculated average earnings and also average investment. Now ARR is equal to average earnings 92,000 and average investment 4,60,000 into 100. The ARR is 20%. Thank you, one and all.